From its peak this year on January 4th until today, the S&P 500 is unfortunately down just around 20%. It is official that we did enter bear territory at least at one point during 2022, and that occurred since the January 4th high of the S&P 500 down to last Friday's, at least intraday, when it was down 20%. So we can, yes, officially say that there was a bear market this year in 2022, and hey, we have all been witness and are investing during this bear market. So if it's your first time, you can say now that you have invested during a bear market. And look, I know no one wants to be someone who had to invest during a bear market, had to invest during a recession, which we're not in. But if you end up this being your first recession that you're investing in, if it happens, then you'll have that under your belt as well. So these are just things that are inherent during times. Like, you're never going to have an investor that's invested for 30 years that has not entered a bear market at some point, has not entered a recession at some point. It's just what happens. It's the way that the economy works. There are ebbs and flows, there is greed, and there is panic. So these things are just normal in the market, and it's figuring out what to do and how to navigate this. It's like that GIF with Super Mario trying to dodge all of those different like fireball things. It's like that. That's what this market has been like right now. This 2022 has been that. And the other thing is, if you're investing mostly in growth stocks, then actually 2021 was really like that for you. So what you're looking at here is from Charlie Bolello. And so what he's showing you is that basically the high growth boom, 2020, is everything in green. So this is what happened during 2020, right? The sheer amazingness of that stock market. And then the preceding 2021 and to 2022 today, and what basically the massacre that occurred. And so you'll see that all of these are basically growth stocks. They're high growth stocks, hyped up. They had great stories, right? And those are the things that you needed to have these types of companies do well. You also, of course, had to have interest rates that were low, stimulus checks, right? The Fed had your back. You had all these things going for you in 2020. And then 2021, 2022 happened, and these stocks have just been annihilated, unfortunately. So if you look down at the least, let's say, or not least, but let's go with, like, for example, PayPal, which is a stock that I recently purchased. So PayPal was up 117% just in 1 year. So was it overvalued? It was overvalued. I wasn't buying PayPal. I wasn't going to buy it back in 2020 because I thought it was too expensive. But precedingly, it proceeded to go down 66%, and I bought PayPal, and guess what? It continued going further, right? And so these are the things that we're navigating right now in this market. I also almost bought Shopify about 2 weeks ago, and I would have been down probably another 15 or more percent if I had done that, which I didn't pull the trigger. And so basically these different companies like Peloton, for example, was up 434% and is now down 91%. It's almost like there are almost no words to talk about how bad some of these stocks have been. But at the end of the day, I just want to really discuss how important it is to not only invest in stocks like these, to have a portfolio, in my opinion at least, or to have some stocks that no matter how much conviction you have, if it's a stock that doesn't really have revenue, or if it's selling at crazy multiples to sales, even if you think that those sales are probably going to catch up with the valuation, then you should, at least I would never just solely invest in stocks like that. I'm always going to have stocks that I think are good based on valuations. I'm always going to have stocks that I think might be some decent dividend paying stocks as well, even in a growth portfolio. So that's kind of what I'm saying is, where do we go from here and what do we learn? Another chart from Charlie is basically showing us here of that the S&P 500's worst performance through 95 trading days. It's the second worst time period ever. And so I'll talk about why this might actually not be that bad of a thing, but it also can be a really bad thing. So take a look here. 2022 is the worst first 90 days starting off a year, basically down 17.7%. We are just a hair, well, we're at least better than the Great Depression of 1932, basically, right? So very bad time period to be investing in that market. So 1939 was the other bad one. 1970s was a really rough time period for a lot. There's a lot of different recessionary periods going on. 1970s, high inflation, high interest rates, So that was a very hard time to invest. Looking down here, 2020, down 8%. So we are looking pretty good comparatively to 2020. Here's another great chart that I found. It was tweeted by Colum Thomas, and it's from Charter, Source, Yahoo Finance, Nasdaq, and it's saying how things could get a lot worse essentially in the market. So basically, this is showing you how bad the percentage fall from the previous stock market peak was. And so this is the Nasdaq. So we're looking at the Nasdaq, which a lot of those stocks I showed you before, they were Nasdaq stocks, right? Because Nasdaq is more of a tech-heavy stock index. So we're talking in the 70s again, like I told you, or I was talking about how things were pretty bad in the 70s in terms of stock market. So in the 70s, the Nasdaq fell 60%. In the 80s, it still had drops of 30% or more. 87, it was down over 30%, right? Then we had .com, right? We had the .com bubble. This thing was down over 70%. We had, again, the preceding 2008 period, right, down another over 70%. And where are we today? Well, we're sitting here at negative, almost 30% for the Nasdaq, not the S&P 500. And so the question is, can it get worse? And the answer is yes, it can get worse. Of course, these different periods were different periods, right? Right now, the consumer is probably better, right? The consumer balance sheet is pretty good. People are actually spending some money. Although maybe it's partly based on inflationary numbers, the numbers that came out recently. But at least people are spending money. It might not be the volumes that you wanted, but the amount of money spent is actually going up. Debt isn't really rampant, but basically credit cards did increase quite a bit. So credit card spending went up recently. It actually spiked. So that's probably not good. So there are little indicators in the market that maybe some things are changing, and then there are other things that are good, like the fact that people are still spending money, the balance sheet of the consumer is good. There's a lot of good things still to hold on to and point at that's going on in this market still. Essentially what we don't have yet, and what I hope we don't end up having, is a 2008-2000 scenario, basically, where housing, subprime mortgages, lending, these little things that we didn't really have on our radar, these black swan events, come out of nowhere, and they pretty much start destroying companies like the banking industry and things that everything is essentially, how do you say it? Everything is built upon, right? So Lehman Brothers, Bear Stearns, right? These things that happened back in 2008. Let's hope that the financial markets are stable, that the things that they put into place back then will actually hold up, and that we won't have major issues like we did back then. And I'm not thinking like that dramatically and drastic and dark right now. I'm still thinking there's still hope to come out of this year a little bit better than we are today. Another really good chart here was tweeted out by Alf, Macro Alf. He's a good Twitter handle also. And I think this was actually from the Wall Street Journal. And basically this is showing you how long these bear markets declines and duration, basically. So the decline is how far down this area goes, and how far to the right it goes is how long it actually lasted. So you'll see the 1940 to 1942 was a much slower bear market decline, right? It took over a much longer period of time, 439 days, to happen. And it just kept kind of slowly bleeding out, you would say. And it just kept going and going. It entered bear territory like a year into it, and then it kept going down. We are much more, the slope of ours is much steeper, and we are, not quite 2007, 2008, but 2007, 2008, where we are now, apparently, if we keep going, we would have to lose a lot very quickly for that to happen. So I don't think we're going to be ending up something like this, where it just drastically goes down further. But again, duration could continue, and we could still end up down here in, let's say, the negative 30 area, right, over the next year. So I don't know what's going to happen, of course. I don't have a crystal ball. I'm not assuming I do know. What I'm just kind of trying to get across is things can get worse. Buying the dip always isn't going to work. Tech stocks may not come back yet. They might come back this year, but it might take a little while. So buy and hold investing is going to be a great thing to do, of course, right now. If you like a stock because you think it's got a good valuation, or let's say you think it's got great free cash flow, you think that it's a good company that sells a great product, that has not too much competition, that's going to actually make money and cash flow its business operations, then maybe that is a great place to put money right now. you'll get a stock cheap, you hold it for many years. And if you look at 2008, which we can see this chart here going back till about, let's say, June of 2006 to 2007 here. 2008 is when the stock market crash happens. And basically what I kind of want to just get across is, does it matter where we are in this part of the downtrend, right? So this is a bear market. We've gone down. So if we're here, look at what happened. How long over this time period did it take to recover your money? So October of 2008, you were early still. The market still declined about, let's say, I don't know, 30% from that moment. But if you just waited another, few, let's say, months to a few years, suddenly you're making 40% on your money. So it doesn't matter where you are. Maybe we're here, maybe we're here, maybe we're here. And it doesn't matter if you're down here at the very bottom. Who cares? Who cares where we are? What I care about is I want to be in a place where I can buy some good companies at good prices that I think will have the potential of being up here, right? Or at least I just invest in the S&P 500 and dollar cost average. There's never been a problem with doing that over long-term periods of time. So dollar cost averaging into indexes, definitely always going to be good. Dollar cost averaging into maybe a specific stock may not always work out, because you might be buying a stock that is a bad stock that shouldn't be invested in right now, or maybe it's a really bad stock like a Peloton. You shouldn't be dollar cost averaging probably into Peloton. I don't think that's probably a good idea, but if you had done that from the peak to now, it's probably a very bad idea. But if you did it from the peak to now of the S&P 500, it's probably totally fine. Anyway, that's all I have for this one. I just want to put this kind of into context, where we are in this bear market, what we can look forward to. Can it get worse? It can, but it can also get better. And even if it gets worse, we can still make money over the long term. So thanks so much, everyone, for watching. I really appreciate it. Hit that like button. I got some affiliate links below if you want to get some Barron's newspaper, or take a look in the description and watch another one of my videos coming up right now.